Next up on our agenda, we've got these items called listed transactions and reportable transactions. What are they? They're just two types of transactions that you need to know that the IRS has designated under these categories. First, we're going to talk about listed transactions. Now, these are going to be specific tax shelters or tax avoidance schemes, so you can see why that the IRS wants to list them out, that were identified by the U.S. Treasury Department and the IRS as potentially abusive. The IRS maintains a list of such transactions in various notices and other guidance issued over time. This is to kind of create a permanent file of things to look out for as IRS agents are going to go around and look into individuals' tax situations. These transactions often involve complex structures or arrangements that have the primary purpose of generating tax benefits such as deductions, credits, or losses that are not supported by the economic substance of the transaction. So yeah, tax shelters, tax avoidance schemes, you got multiple shell companies and you're trying to get that money through the shell companies without having to pay tax on that. That is going to be tax avoidance. What is an example here? And not that you really need to know examples, these are just here to illustrate for you. There's a transaction called a son of a boss transaction. It's a well-known listed transaction and a form of a tax shelter from the IRS's list. In this arrangement, a taxpayer contributes a highly leveraged asset, meaning there's a lot of debt on the assets. You borrow $10 million to buy a $10 million house. So yeah, it's $1 of debt for every dollar of the value of the house, which results in overstating the taxpayer's basis in the partnership interest. So we use a lot of debt to buy a lot of assets and we contribute those to a partnership. This inflated basis allows the taxpayer to claim artificial tax losses on the disposition of the partnership interest or the partnership's assets. Don't worry about it past just seeing that this is a transaction to manipulate taxes or avoid taxes. It's not like you're going to be asked anything about these complex transactions on the exam. Now, the importance here, identifying and reporting them is, as you can probably imagine, it's going to be crucial for IRS agents to be familiar with these in order to combat tax avoidance schemes and make sure everyone is in compliance. Taxpayers, promoters, and material advisors involved in these listed transactions are required to disclose their participation in such transactions with the IRS. So if you are a professional and you do not list your participation in any of these things and make it well known that you are a part of it, then you're going to have penalties, fines, criminal charges, all that good stuff. Tax avoidance, not a thing to joke about. Next up, we got reportable transactions. And again, just a type of transactions, a category to make sure you understand what they are so you can answer multiple choice questions on the exam. These are going to be those transactions that the U.S. Department of Treasury and the IRS believe have the potential to be used for tax avoidance or tax evasion. So these are potential situations that could be set up to cause tax avoidance, whereas this is a straight up situation where, there's probably no doubt this is being set up to avoid taxes. Now, these transactions may not necessarily be abusive in nature, but they possess certain characteristics that warrant additional scrutiny. They generally fall into one of 5 categories. We've got listed transactions, which is probably the most severe there, confidential transactions, transactions with contractual protection, loss transactions, and transactions of interest. So an example here being a taxpayer enters into a transaction that generates a tax loss of $2 million or more. It's kind of like a transaction that raises a red flag. Now, inherently, is this possibly sketchy? I mean, it could be, but it's not necessarily. I mean, could you legitimately have a $2 million loss or more? Yeah, that's could be just another day for you is losing money, right? But inherently, massive losses trigger red flags, and as such, that is a possible reportable transaction. Now, this transaction is going to fall under the lost transaction category. It must be disclosed on the taxpayer's tax return. This is very much, as you could probably tell, dealing much more with companies and high net worth individuals. So not something we're ever going to really have to worry about. Well, hopefully, maybe one day you bring home the big bucks, as I wish you do. And what's the importance here? The importance here is, again, to help the IRS identify potentially abusive arrangements and to make sure that everyone's doing their job, reporting everything properly. The IRS can scrutinize the transactions and catch anyone who is not disclosing these particular reportable transactions. In summary, these are both important for tax compliance. It helps the IRS to identify schemes and possible intentional actions on individual or company behalf to avoid taxes. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of cpa.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because Who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.